You ever made a money decision that seemed harmless at the time, only to regret it days later? Maybe it was a forgot subscription, an irresistible sale, or a tip from a coworker. These choices often feel smart and responsible in the moment, but over time they can quietly drain your wallet and shake your confidence in your financial instincts. The worst part, you might not even notice it happening until it's too late. But what if you could stop this chain reaction before it starts? That's what this video is all about. Imagine if one simple rule could change how your bank account looks in just 1 month. That's exactly what Warren Buffett shared with students back in 1985. He said, "Rule number 1, never lose money. Rule number 2, never forget rule number 1." It sounds almost too simple, right? But there's a reason this rule has stood the test of time. It's not about never spending or being cheap. It's about a specific kind of discipline that protects what you already have so it can actually grow. 30 days I decided to live by Buffett's rule with absolute seriousness. Every purchase, every investment, every financial decision was filtered through one question. Does this risk losing the money I already have? What happened over those 30 days completely changed the way I think about money, and I believe it can do the same for you. Let's dive into what Buffett really means by never lose money, and how applying this rule can transform your finances. Most people misunderstand Buffett's rule. He's not saying you should avoid all risk, because that's impossible and honestly boring. Every investment carries some uncertainty. What Buffett is really talking about is asymmetric risk. That means only putting your money in situations where the downside is small and the upside is huge. It's about making bets where if things go wrong you lose little or nothing, but if things go right you gain a lot. Picture this: you're standing at the edge of a cliff. On one side there's a 50% chance you find a gold coin. On the other, a 50% chance you fall and lose everything. That's a bad bet. Now imagine a sturdy bridge. On the other side there's still a 50% chance for a gold coin, but if you don't win you just walk back, no loss. Buffett wants you to take the bridge, not the cliff. The downside is controlled, and over time those safe bets add up to real wealth. This is exactly how Buffett built Berkshire Hathaway. He didn't make one big gamble. Instead, he made thousands of decisions where the downside was protected. He bought companies with strong fundamentals, steady cash flow, and competitive advantages. He avoided things he didn't understand, like dot-com stocks, crypto, and meme stocks. If he couldn't clearly see the downside, he simply didn't invest. That's how he avoided big losses and let the winners carry his portfolio. Finance professor found that all the gains in the US stock market since 1926 came from just the top 4% of stocks. That means 96% of stocks added zero net wealth. The winners carry the market, but the only way to own those winners is to avoid blowing up on the losers first. Buffett's rule isn't about chasing gains, it's about preventing losses. That's the real secret to building wealth over time. The first day I looked at my subscriptions, I found 7 recurring charges I'd forgotten about: a streaming service, a fitness app, a premium email tool. Together they added up to 2,400 rupees a month, nearly 29,000 rupees a year. Not because I needed them, but because the money was leaving automatically. Buffett's rule applied to subscriptions was brutally effective. I canceled all 7 and redirected that money. It felt like a small victory, but it was just the beginning. Friend sent me a hot stock tip: a small pharma company about to announce a breakthrough. The stock had already jumped 12% in 2 days. Normally I might have thrown in some money just in case, but Buffett's rule made me pause. What's my downside? If the stock crashed, I'd lose everything I put in. The chance of tripling my money was low, and chasing outliers is a losing game. I passed. 3 weeks later the stock dropped 41%. My friend lost money, I lost nothing. At day 12 I started thinking deeper. My savings account was earning a modest interest rate, but inflation in India was higher. That meant my money was actually losing value every year. A report confirmed that real returns on savings had turned negative for many. Losing money isn't just about dramatic crashes, it's also about slow leaks from inflation, fees, and opportunity cost. I moved some savings into a low-cost index fund, where the downside was much lower over time. Historically, the Nifty 50 index has delivered about 12% annualized returns over 20 years. While nothing is guaranteed, the downside over any 10-year period has been close to zero. That's Buffett's rule in action: protect your downside, then let compounding do the work. By making this shift, I wasn't just avoiding losses, I was setting myself up for steady long-term growth. At day 18, something unexpected happened. I started saying no, not just to risky investments, but to anything that felt like a leak. A coworker invited me on a weekend trip that would cost 8,000 rupees. I wanted to go, but I asked myself, is this protecting my money or draining it? It wasn't an investment in myself or my relationships. It was just fun. I passed and put the money into my index fund instead. Small decisions like this add up over time. Study by Fidelity found that the best performing investors were often those who did nothing, people who forgot they had accounts. They didn't try to time the market or chase trends. Doing nothing is underrated. Sometimes protecting your money from yourself is the most important financial skill you can learn. Buffett's rule helps you pause and avoid unnecessary risks. On day 25, my landlord mentioned a commercial space for lease. The rent was affordable, and I started dreaming about opening a small business. On paper, the numbers almost worked, but Buffett's rule forced me to look at the downside. The lease would lock me in for 3 years, and the initial investment would wipe out my savings. The odds of success were low. I passed and slept better knowing I'd protected my finances and my peace of mind. Every time you risk money you can't afford to lose, you're not just gambling with your bank balance, you're gambling with your peace of mind. Buffett's rule isn't just a financial strategy, it's a mental health strategy. By protecting your downside, you sleep better and worry less. That's a benefit most people overlook, but it's incredibly valuable. At the end of 30 days, I sat down and looked at my numbers. I had saved an extra 53,000 rupees, 29,000 from canceled subscriptions, 8,000 from the trip I skipped, and 16,000 from avoiding risky investments. My index fund grew by just over 1% in 18 days. It wasn't a spectacular return, but combined with the money I protected, my net worth grew more in 1 month than in the previous 6. Not by earning more, but by refusing to lose money. Let's be honest, Buffett's rule isn't magic. It won't make you a millionaire overnight or protect you from every bad outcome. Markets crash, businesses fail, and life throws surprises. But this rule does something more valuable. It rewires how you think about money. It turns you from a reactive spender into a deliberate protector of your wealth. That mindset shift is the real win. Once you start asking, what's my downside? Before every financial decision, you can't stop. It changes how you shop, invest, negotiate, and plan. It transforms your relationship with money from something passive and unpredictable to something intentional and compounding. That one question separates people who build wealth from those who lose it. Here's the best part: you don't need to be Warren Buffett to think like him. You don't need a billion-dollar portfolio or a finance degree. You just need one rule, one filter, one question for every money decision. What's my downside? Try it tonight. Look at your bank statement. Find the leaks and risks. Stop them, not because you're cheap, but because your money is the foundation for your future wealth. Every rupee you protect today is a rupee that works for you tomorrow. A foundation with holes can't support anything heavy. By plugging those leaks and avoiding unnecessary risks, you're building a solid base for your future. 30 days from now, you'll look at your bank balance and feel something new, not just relief, but clarity about where your money is going and what it's doing for you. So, are you ready to try Buffett's rule for yourself? Start tonight. Ask yourself, what's my downside, before every financial decision. Find the leaks, stop the risks, and protect the money you already have. It's not just Buffett's rule, it's your rule now. With this mindset, you're not just saving money, you're building a future where your wealth can grow safely and steadily. Start tonight and see the difference in 30 days.